Hey everyone, glad you're here. Big news just dropped. The Federal Reserve cut interest rates for the first time in 9 months, bringing them down to a range of about 4% to 4.25%. That may sound like just a technical move, but changes like this can ripple into your everyday life in ways you might not expect. We're talking mortgages, credit cards, savings accounts, even the prices you pay at the store. And on top of that, there's a political twist to all of this that's making the debate even more intense. So stick with me, because understanding what's going on right now can help you make smarter money choices. Before we dive in, I'd love to hear your thoughts. Do you feel interest rate changes really affect your day-to-day finances? Or not so much? Drop a comment below. And while you're down there, don't forget to hit that subscribe button. It helps us grow this community and bring you more useful updates. Now, let's break down what this rate cut actually means. For years, we've been told lower rates make borrowing cheaper. Mortgages get more affordable. Credit card interest comes down. Businesses can borrow money more easily. Sounds good, right? But here's the reality. In today's economy, the benefits don't always show up the way we'd expect. Take mortgages. Even after this cut, the average 30-year loan is still sitting above 6%. That's way higher than the 3% rates people were able to lock in just a few years back. And because lenders and markets already expected this move, your mortgage quotes aren't going to suddenly drop overnight. What about refinancing? For most homeowners, it doesn't help much. Usually, you need at least a half-point difference in rates to make refinancing worth it. Right now, that kind of gap just isn't there. If you bought your home during the pandemic when rates were low, keeping your current deal is still the smarter move. And credit cards? That's another area where people hope to see relief, but the truth is different. The average credit card APR today is around 20%. Even with this Fed cut, experts say cardholders are barely going to notice. In fact, some analysts flat out argue that no matter how much the Fed cuts, credit cards won't ever become a cheap way to borrow. That's why if you're carrying balances, this move won't suddenly save you. The best strategy is still tackling that high-interest debt as fast as possible. Something else that often gets overlooked: the ripple effect on prices. When borrowing costs shift, businesses adjust, and it can trickle down into the cost of groceries, gas, and other essentials. It may not show up directly in your paycheck, but it does influence what you pay at the register. Now let's talk about savers. This is where you might feel the change more clearly. Over the past year, online savings accounts were paying over 5%. That felt great. But with rates coming down, those returns are already slipping closer to the mid-4% range. And if more cuts happen this year, expect them to slide further. It's not a reason to panic, but it does mean the easy money from high-yield accounts and CDs might not last. Some analysts have even called it a comfort blanket that could be pulled away sooner than people think. So what can you do? Well, some banks are still offering no-penalty CDs, for example, a 7-month option around 4%. That gives you both yield and flexibility, and it might be worth grabbing before rates dip lower. And if you want to branch out, some advisors suggest looking at short-term bonds or high-quality corporate debt. They're not for everyone, but they can provide a little more income without a lot of extra risk. The key is being intentional and not assuming your savings rate will stay the same. One more important reminder: emergency funds matter more than ever. Experts recommend 3 to 6 months of expenses in a liquid account, even if the returns aren't amazing. Why? Because nearly half of people who fall into credit card debt do so because of emergencies, car breakdowns, medical bills, or urgent home repairs. Without savings, you end up swiping a high-interest card, and no Fed cut will protect you from that trap. So even though the headlines sound dramatic, the real-life effects are much more muted. But let's shift to the political side. Former President Trump has been pushing hard for deeper cuts, arguing that high rates are hurting housing and increasing government borrowing costs. He's even appointed new Fed officials who wanted bigger moves this time. At the same time, there's visible tension between the White House and existing Fed members, even court battles over appointments. That has raised real questions about the Fed's independence. Are these decisions based only on economics, or are politics creeping in? That matters because the Fed's credibility depends on staying separate from political influence. Jerome Powell tried to downplay the tension, saying there wasn't enough support for a larger cut. But the divide is clear. And for everyday people like us, that adds another layer of uncertainty. If politics start steering policy, the direction of rates could become less predictable. Now, let's look at investing. Lower rates often make savings accounts and CDs less attractive, which pushes some money into stocks, especially dividend-paying ones. Companies that reliably raise dividends, sometimes called dividend aristocrats, often get more attention when bond yields slip. Financial stocks can also benefit since banks and lenders get to refinance and borrow more cheaply. But don't assume falling rates mean smooth sailing. If inflation stays sticky, real returns take a hit. And if the economy tips into recession, stocks can fall regardless of what the Fed does. So balance is the name of the game. Rate cuts don't happen in isolation. They're a signal about where the Fed thinks the economy is heading. That creates uncertainty, which means more swings in the market. If you're watching your portfolio, that can feel unsettling. Here's the hidden lesson. Rate cuts are more of a warning sign than a magic fix. They signal concerns about growth, jobs, and inflation. But they don't immediately lower your mortgage, shrink your credit card bill, or boost your savings. What they do is set the stage for how you need to respond, paying off expensive debt, locking in good savings deals while you can, and making sure you're not waiting for the Fed to solve your money problems. And perspective matters. The days of zero interest rates are behind us. We're in a middle zone now. Rates aren't crushingly high, but they're not rock-bottom stimulative either. That means we all need to stay flexible, resilient, and forward-looking. So let me throw the question back to you. Do you think this cut will actually impact your finances, or does it just feel like background noise? Share your thoughts in the comments. I love hearing how you all are experiencing these changes, and your input helps others too. If you found this breakdown useful, hit like, subscribe, and share it with someone who could benefit. The bigger we grow this community, the more we can help each other make smarter financial decisions. Thanks for watching, and I'll see you in the next one.